2025 was a mixed year in Australia. The ASX 200 delivered an underwhelming 4.7% return as of mid-December. However, on a macro level, there were signs of green shoots and an uptick in growth, but off a very low base. The good news in 2025 was that GDP growth accelerated on the back of the consumer bringing the private sector back to life. 3 rate cuts from the RBA alleviated some household pressures, and solid wage growth saw rising disposable incomes, which boosted consumer confidence. Now, these factors, alongside a positive housing market, resulted in a happier consumer. It was the first time in years consumers were buying more, not just paying more for the same level of goods. Now, the cause for optimism looks increasingly likely to dissipate in 2026. The increase in consumer spending, particularly the spending on services, has the RBA on high alert due to the spike in inflation. Expectations of further rate cuts quickly evaporated, which is likely to dampen both the housing market and consumer optimism. The real issue for Australia looks to be that real wages cannot rise without creating inflation pressures, as seen in the recent inflation data, which creates an air of macro stagnation. So what does this mean for the equity market? The ASX is now trading on a forecast PE ratio of over 20 times, nearly 30% above the average valuation since the turn of the century. The rise in valuations has been relatively concentrated, with the most expensive 10% of the market becoming increasingly expensive to levels rivaling the dot-com bubble and the 2022 inflation sell-off. As these two examples have shown, should economic data disappoint, these companies will be hardest hit. We see an increasing environment that will reward disciplined investors who are able to spot the rose amongst the thorns in the other 90% of the market. Valuations can stray for periods, but the recipe for long-term success remains the same: buying quality businesses at fair prices and allowing them time to prosper. Thanks for joining me.